Welcome to AHA Math and Science. In today's video, we'd like to take a look at the current slump in the U.S. home price. Specifically, we want to analyze the Case-Shiller National Home Price Index, and we want to see where it's heading. So the Case-Shiller Home Price Index is one of the leading measures of U.S. residential real estate prices. And shown here is a plot of this index from 1988 to the present time. You can see a clear uptrend in the past 35 years, and it's interrupted by a few slumps, and notably the one in 2000, starting in 2006, following the subprime bubble. And there's also a minor one in the early 90s. And it looks like right now it's sort of kind of trend down a little bit. And we want to note that in this plot, there's also a few shaded regions. These are the recessions. And one interesting thing that we can see is that a recession is not always accompanied by a slump in the home price. For example, after the burst of the dot-com bubble, we have a recession, but the home price does not go down. And also in the pandemic, there's a brief recession, but the home price actually keeps going up. On the other hand, whenever the home price starts to slump, it's always accompanied by a recession. So here in the early 90s, home price started to go down, and then shortly after a recession starts. Here, the home price starts to go down, and then shortly after a recession follows. And now we also have the home prices going down. So if history is any guide, and it's likely that we will probably going to be in a recession period in the coming months. And this is kind of like consistent with another analysis we did a few days ago by looking at the unemployment rate. And in that video, we conclude that a recession is probably coming at some point. So if you're interested, you can take a look at the video, and the link is below in the description. So now the big question is, what happened to the home price index in the coming months? Will the slump continue? How deep the slump will be? These are the questions that we want to answer in this video. So in order to answer these questions, let's look at the home price index more carefully. And we like to actually analyze the price using the formula of compound return. So according to that formula, any investment, when plotted on the log scale versus time, the data should more or less follow a straight line. So indeed, in this case, we can see that the Case-Shiller home price index, when plotted on log scale, even though it goes up and down, but it generally follows this trend line. This is the red line there. It's a straight line. In fact, the fit is very good with R-squared value 0.91. Note that when this value R-squared is 1, that means the model fits the data perfectly. So 0.91 is not bad. It is indeed a decent fit. And we also note that using this fit, we can find the average annual return is about 3.85% based on this data. So that's reasonable given that this is the U.S. National Home Price Index. So 3.58% appreciation average per year. And also shown on this plot are the two pink dashed lines. These are two standard deviation above or below the trend line. Statistical analysis says there's a 95% probability for the price to fall within this band. And also shown here are the two black dashed lines. These are one standard deviation above and below the trend line. So you can see that 95% probability means like there's 5% probability for the price to go above the 2 sigma or go below. Indeed, this is very rare, but it did happen during the subprime bubble when the price just kind of briefly above the 2 sigma. And Now we want to note a few interesting cases. For example, in the early 90s, the price goes above the trend line. It started kind of almost approaching the 1 sigma trend line, but it don't really touch it and start kind of trend downward. And a couple years later, actually 5-6 years later, the price almost touched the standard deviation, the negative 1 standard deviation trend line, and then start kind of bottom up and then start to rally. It goes up again. And then in following the subprime bubble, you can see the price peaked and actually goes above the 2 sigma plus 2 sigma trend line. And then it peaked and it started kind of going down. And 5-6 years later, it bottomed. It goes below the 1 standard deviation and almost touching the 2 standard deviation trend line. And then start to go back up again. So currently, the home price index peaked in June 2022. And you can see the peak right at here. And now it's kind of going downward. So if history any guide, we expect this index to kind of continue to go down and go below the trend line, and perhaps we touch the negative 1 standard deviation trend line. So in the previous slump, you can see that it's quite a bubble. So here maybe the slump will not be as severe as the 2006 bubble. So it may not go all the way to negative 2 sigma. Maybe we just stop at the 1 standard deviation trend line. So even that's still it's going to be a slump. It's going to be a quite appreciable drop. And also the time frame in the previous slump, it takes about 5-6 years. The recent bubble probably is not as severe. Maybe it takes less time, but still it's going to take a few years. So if we can kind of project that maybe we will see this kind of drop with a very quick drop first, then start kind of drop slowly. And so if we extend this 1 sigma trend line, we suspect that the index probably will bottom around the 240 level. So put all this analysis into a summary and put the data into a table. This is the comparison we have. The current one versus the previous 2006 to 2012 slump. So in the previous one, the home price index peaked at 184 in 2006. And then it bottomed at 134 in late 2011 and 2012, early 2012. So for a total drop of about 27%. For the current one, the home price index peaked in June 2022 at 308. According to the analysis we just did, we suspect that the index probably will bottom around 240 for a total drop of about 22%. Note that this is the national average. So in places where home price has increased a lot in the recent years, the drop may be bigger than this. And then in other areas, maybe it's smaller than that. So this is just a national average. And at the time frame, the previous slump takes about 5-6 years. The recent one, this current one, probably may take a slightly short time, but it's still going to take years. So we suspect that the current slump will maybe take 4 to 5 years, and possibly ending around 2026, 2027. So it looks like the slump, it will not be like just like a short term thing. So I hope this analysis is helpful, and I hope you have enjoyed this video. Please do not forget to click the like button or subscribe to our channel, and so you can see more videos like this one. And thank you for watching.